evening and welcome to The Money Show, the only daily show of its kind which brings the market's top financial experts to answer all of your financial query. I'm Avni Raja. Lots of personal finance talk lined up, but first a quick look at what's making the headlines. Markets recover from the day's lows as investors start checking into PSU banks in the last hour of trade. Metals and realty remain under pressure. Mirae Asset Mutual Fund further restricts inflows into its emerging blue chip fund from 15th of December. SIPs into the fund will be allowed only on the 10th of every month and will be restricted to 25,000 per person. Capital markets regulator SEBI asks mutual funds to submit their proposals for rationalizing schemes by December 15th. SEBI has mandated that fund houses will be allowed to offer only one scheme per category. All right, joining us on the show today is Lovaii Navlakhi, founder and CEO, International Money Matters. Thanks very much, Lovaii. Pleasure to have you on the show. Before we get to all the personal finance queries that we have, one important question that I wanted to ask you is with respect to, the mid-cap funds. There are several funds, like I was just mentioning, the most recent one, Mirae Asset, that have restricted their flows into them. So my question to you is, whether it's existing investors or new investors, what should the strategy be if I already have investments in these mid-cap funds, and if I want to invest fresh money into mid-cap funds?
Yeah, I think it's a good question. It's very relevant today. The important thing is that when schemes are investing in mid-caps, what happens is that at some point they get larger and larger in size once they're performing. And as a result of wanting to maintain liquidity, what these funds tend to do is to then buy large caps into those schemes. And then the automatic result is that performance starts dipping. So when you get schemes which voluntarily sort of restrict the amount of money that's going to go into that fund, what comfort it gives us advisors is that that scheme is going to be true to its form, true to its mandate. And that gives me a big thumbs up for that scheme. And I would recommend then that we know that that scheme is always going to remain mid-cap oriented. And as long as you've determined with your advisor that the money that you need to allocate to mid-cap, what that amount is, then remaining invested in that fund or adding more money based on the scheme and the rules of that fund is really good.
Right. So just for our viewers, I'm going to just list out the funds that have been restricted flows. It's DSP BlackRock Microcap Fund, IDFC Focused Equity Fund, SBI Small and Mid Cap Fund, L&T Emerging Business Fund, as well as Mirae Asset Emerging Blue Chip Fund, which is the latest to join that list. Lovaii, let's get in fact to our first query, which comes in from Anand. He says, what's a good plan for a retired person to invest in a mutual fund to generate regular income? Again, Lovaii, we get a lot of questions from, specifically for retirement planning and how to generate regular income. But what would be your advice for Anand?
So I think when somebody is in retirement, they are looking at regular sort of cash flow. So you want something that is going to give you that sort of fixed type of return equivalent to a fixed deposit. And that's something that you want on a regular basis. What we have found, if we sort of look at some back testing of data, that if you actually invested something like 20 lakh in a short-term fund, then that would sort of pay off for you an amount that you wanted regularly of 10,000 rupees a month for the next 8 or 9 years, and that money would get over. But if you actually had put it in a hybrid fund, that even if you got something like 11% per annum for say 9 years, that money is sort of intact. It's actually grown and you've continuously got that fixed amount of money that you wanted every month. However, this is a bit complicated in the sense that you genuinely need an advisor with you. So the recommendation that we have is, depending on your tax bracket, is to look at a systematic withdrawal plan from a hybrid type of fund. Again, keeping in mind your asset allocation, and that probably is the best sort of combination.
All right, Anand, hope that answers your question as far as retirement planning goes. Our next query comes in from Divakar Roy, who says he's a regular investor in mutual funds, gets good returns. needs the money back in 6 to 12 months. What's the good time to redeem it, and where to invest if I redeem it today? So Lovaii, short-term investment horizon, there's probably for some specific reason he wants to withdraw. What should be his strategy?
I think his question is coming from the fact that in the last 6 months to 12 months, there have been really good returns in the equity market.
Yes.
So can I put it somewhere and generate, we can get 5 or 10% absolute returns? And I think that's the wrong way to go about investing. We pretty much would restrict our recommendations to liquid or short-term funds if your time horizon is 6 to 12 months, and only look at equity if it's like a 3-year plus type of time horizon. So unfortunately, we are going to give him a very mundane answer of investing in a short-term debt fund. And then I want to pick a scheme which has good quality paper as well as does not have exit loads for that short period of time. So at the moment, we can think of 2 schemes, IDFC short-term fund, which is IDFC SSIF, and there is a UTI short-term fund. So one of these 2.
Okay. All right, that's as far as investing for the short term is concerned. Lovaii, in fact, taking forward from the point you were just mentioning about where, markets are today and how people are approaching their investments and thinking about whether they should book profits or not. The entire balance between greed and fear, and at this point, one should ideally exercise a lot of caution when it comes to one's investments, especially equities. But what is the advice for investors? How should they ensure that they balance out, the way they approach their investments, especially when markets are at these levels?
Yeah, so I think the starting point for many investors is, what's the type of returns I've got in the past? And that's not really the best way to do it, because you tend to look at the more recent past. The important thing is to try and understand market cycles and look at the time horizon at which these sort of cycles sort of play out. And as a result of which, you will realize that if you really want to be getting the type of returns that you want from equity, first and foremost, you have to have a long-term time horizon. 2, you have to stick to an asset allocation. 3, you have to be extremely patient with your investment. So if you're not in a position to be patient, then, it's not right for you to be investing in sort of into equity markets. There is obviously the element of trying to protect the downside risk that people have. And from that point of view, it's important to, again, not look at the portfolio or an investment by itself, but as a portfolio as a whole, and then break it down. There'll be a certain element of money that you want to invest where you want liquidity. There's a certain money that you want to invest where you're trying to beat inflation. And then there is a third part, which is looking at growth. So as long as you're able to separate out these buckets, and these typically will get linked to some of your financial goals, you will be able to sort of be investing in each of these components, get the maximum return, protect the downside, and sleep well at night. So I think sticking to asset allocation is pretty much the message that I would say.
Right. So when investors write in saying, asking whether they should exit their investments because of the current level of the markets, that's not what one should do ideally. You should, if it's time for you to withdraw based on your financial goals, only then should you withdraw, and not based on where the market levels
are. So the
only
case where there could be a reason to exit would be that based on your allocation, you were expecting certain type of returns, you've made more than expected return.
Okay.
As a result of which your allocation has now got skewed, and what we typically talk in financial planner language is an rebalancing of your portfolio. So you wanted to be, say, 55% in equity, you started with 50, now market's done very well, so you are at 60, yes, bring it down. Okay. You don't have to bring it down to the, to the base level. You might even want to go lower, depending on that's more a tactical call. But it's never 0-1. And I think many investors want to know whether should I be all in or all out. And that's what you do in poker and not in investing.
All right. Well, let's get to our next query. Comes in from Damodar from Mangalore. Says, considering the increase in inflation now, what are the good debt products to invest in? Time frame of 2 years. So he's looks like he's quite a cautious investor. He wants to take into account the inflation risks that one probably faces with investments. What would be your advice for him?
So again, I think if you were to look at the cycles of debt products, what we find is sometimes these debt interest rate cycles actually last more than 2 years. So sticking your neck out and saying, you know, what's the best sort of investment in debt for 2 years is going to be risky if I tend to look at something which is more longer term in duration. So as soon as I have debt funds which have longer duration products as underlying, the risks sort of go up, because if interest rates were to move slightly higher, then those funds will have a more negative sort of impact. Debt funds is definitely a good option for people who have, you know, higher tax bracket versus a fixed deposit. So to reduce the risk from this time horizon point of view, at this moment we think that short-term debt funds are a good bet because the duration is a little shorter, so the impact of interest rate movements is little less. So you might not make a lot of money in the short-term debt fund if interest rates were to come down. But otherwise, I think from a 2-year time horizon and today's standpoint, we would put money into short-term debt funds.
Okay. Lovaii, the other thing is we see a lot of investors really putting money into fixed deposits because, you know, saying that it's a much safer way of investing and short returns and all of that. But given the current environment where we're seeing interest rates also falling and inflation also on the rise, if you can take us through why one should rather opt for debt funds rather than fixed deposits.
So I think first and foremost, when I look at sort of safer investment options like fixed deposits, I think the important thing is to compare them on a post-tax basis and then look at the same time horizon. So if I'm putting money in a FD for 1 year, then what's my return? What's the tax implication? What's my return after that? Then I think it's a question of evaluating versus inflation. Now, if am I making plus after tax, you know, keeping inflation in mind, and if it's minus, then that's really the riskiest place to put money, because 100% of my time I'm going to lose my purchasing power, which is why we then start looking at debt funds because their tax treatment is slightly better, and based on the time horizon we can probably decide which type of debt fund to put money into.
All right. Our next question comes in from Ashutosh Kumar from Pune, who says, I have invested in mutual funds for 3 months. Market is fluctuating. Is it a good time to invest more? Lovaii, again, you know, similar thread that we're seeing, similar kind of questions coming in. Again, short-term investment here. What's your advice?
So I think the good thing is that people are looking at mutual funds, and I think that's been a big sort of thrust and change in the last few months, and probably helped by the way the markets have performed. So the question really I have for this investor is that since you invested 3 months ago, what was the outlook with which you started investing? What was your time horizon? And I think the thought I am having is that he started investing with, say, 100 rupees available, but he only put 30 rupees in, and now he's feeling, oh, I should have put some more money. Is it now a time for me to put more money in? Now, first and foremost, if I have money available with me, then putting it away in a systematic sort of manner is something that you typically do to, you know, the systematic investment plan, which is very popular, is typically done by people where your income is going to come later on. If you already have money in hand, there is also a systematic transfer plan available. So you could invest lump sums in a liquid fund and then make sure that on a regular basis, whether weekly or monthly, some money is moving into the market. Because it's really going to be very difficult for you to, you know, time or predict the market. And as a result, you know, you might feel that, oh, I've not put my money in. So stagger some of the money. Some of the money you can even try and say, okay, every time the market falls 5%, I'm going to put some lump sum in. There should be some sort of discipline around it. And that, I think, is something that we keep trying to build with investors.
Absolutely. Ashutosh, you heard what Lovaii had to say. Ensure that you continue to be disciplined with your investments, whether it's an SIP or it's an STP, and don't worry so much about market fluctuations. All right, moving on to the next question coming in from RV Rao, says, what do you think will be the future of long-term debt income dynamic bond funds in the coming months? Lovaii, essentially, I think he's just asking what is the outlook as far as debt funds are concerned, probably looking at investing and figuring out how to plan his debt investments.
Yeah, and I think something you spoke about at the start of the show about SEBI talking about categorizing.
Yes.
So that you have some names today in the type of schemes which people don't understand what they mean, and each of the fund houses actually pretty much determine how they're going to run that type of fund. So first and foremost, I think in these debt funds, what you have to remember is that the longer the duration of the fund, that is what the type of underlying investments that they are holding, the greater the risk of losing out if interest rates go up. Of course, there's a much better chance of making more money if interest rates were to go down. I think at this current point in time, it does look a little uncertain about whether interest rates will come down. There seems to be more chances of interest rates actually going up in the short run, and which is why you want to be in the safer end of the debt investment product, the type of product that you're putting your money in. So short-term funds may be a better bet today. Dynamic bond funds probably a year and a half ago seemed attractive because it looked like our interest rates were only heading downwards, but that's not happened. And as a result, some of the dynamic bond fund and some of the government security funds, which technically have no risk, have made very little return in the last 1 year. Actually, shorter term debt funds have made much more return. So, and also you have to remember that debt funds come with a higher sort of duration for you to be invested in to make a better sort of taxed rate, which is your long-term capital gains kicks in only if you are holding debt funds for more than 3 years. So you have to have a 3-year view if you are looking at post-tax. And because we are uncertain about interest rates coming down in the next 3 years, in a significant manner, we would much rather invest in short-term debt funds at this moment.
All right, that's as far as debt fund investments and how to plan them is concerned, but we're completely out of time. Thank you very much, Lovaii. Absolute pleasure having you on the show.
Thank you.
That's it from us on The Money Show, but keep your questions coming in. If we haven't got to them, we promise we'll get to them in the next few days. You can connect with us, all the details up on your screens, either on Twitter or email us, themoneyshow@etnow.tv, or you can even connect with us on the phone line or on Facebook, and we'll get all of your questions answered right here. Thanks for watching.